Right. Good afternoon, ladies and gentlemen. Welcome to this session today. Very sorry for the shifts that have been happening. I've got a problem that I've got students who are writing exams, and it seems as if my Saturday and Sunday these days are just too hectic because of exams. So I think I'm going to inform you in the group that for temporarily until the exams are done, I'll be shifting that Saturday class. I'll be shifting it to midweek. It should be Thursday or Friday in the evening. So I will tell you in the group. Should be Thursday after the auditing. Then we do text. I will inform you in the group Thursday or Friday. But I think Thursday will be. I will see because there are two classes that I have to put there. I will tell you, but it's temporary. Uh, Probably until the exams are done because the Fridays and Saturdays now they are hectic because of the exams. So from this week, so that you don't miss out, because I know some of you are doing text 3761. This applies to those who are doing text 3761 because I know that you are writing a test very soon. Because those ones who are writing text 3701, I understand that you are writing your exam during the week. Right, this session was mainly called because of the text 3701 guys that are writing an exam during midweek. But it can also help you if you are doing text 3761 to revise some of the concepts and some of the things that we have not yet done for you to also have a feel of what they are about. So for those who are doing text 3761, actually, that's why I said that for today it can be an optional, but it can also be very helpful. And I repeat, for those who are doing text 3761, I'm going to move the class temporarily because I don't want you to be disturbed every Saturday. And then you wait, and then you see that I delay, then maybe by the time that I finish, there's load shedding and all those things. So I'm going to move your class to Thursday. There should be 8 o'clock, Thursday, 8 o'clock in the evening. I'm going to move your class to Thursdays. Right. So today we're going to do a revision for text 3701. So we're going to be using the paper that I gave you. Then when you find time, you can also do the other one. My main focus would be on the January 2020 paper. Right. So I'd say use right. A rainy day private limited manufactures and sells raincoats and gumboots approved by the commissioner as a qualifying process. Right. Of manufacture, and there's a February end. Right, in your head automatically you should now be able to know that if it is a qualifying process of manufacture, then if it is a small business corporation, it will qualify for section 12E deductions. But if it is not a small business corporation, it will then use the section 12C deductions, which are applicable to assets that are approved to be used in a process of manufacture. Right, the company is registered a registered value-added tax vendor. All amounts exclude VAT unless otherwise. All right, so we should know that whatever we are dealing with, there is VAT, and is not a small business corporation as defined. So if they are not a small business corporation, that means we are not going to talk about section 12E. We are not going to talk about section 12E deductions that are applicable to a small business corporation and will not apply the tax rates applicable to a small business corporation. The company entered into the following transactions for the year of assessment ended on the last day of February. We have transaction 1 and then transaction 2. Right now, they want you to calculate the taxable capital gain. Actually, this is the topic that I wanted us to look at as a part of our normal class. So actually, that's what we are looking at, even for those who are doing TAX3761. But basically, I was supposed to start from the concepts. Right, let me just give a brief summary. Right, when you sell an asset at above what SARS calls the base cost, there will be what we call a capital gain. If you sell an asset above the base cost, there will be what we call a capital gain. Right, now this capital gain, a company will only be taxed on 80% of the capital gain. Only 80% of the total capital gain will be taxed. Right. If a company makes what is called a capital loss, it's also very possible to make a capital loss. That is when the proceeds from the sale of an asset are less than the base cost, then there will be what we call a capital loss. If a company makes a capital loss in any particular year, they can be able to use that as a deduction in future against any capital gains that they are going to get in future. So whenever they say calculate the taxable capital gain, that means you have to, for each asset sold, so it applies to assets sold anyway. When we're talking about capital gains, we're talking about assets disposed of, right? So you have to determine your proceeds, then your base cost, then you see if there is a capital gain or not, and the overall capital gain. If there's a capital loss brought forward, you then deduct it from the capital gains made. Then you determine your taxable portion, which is 80% of the profits for businesses. I think you learn later that for individuals it's around it's 40%. It's not 80%, right? So now let's deal with these transactions one by one. So we first deal with transaction 1, right. Calculation of taxable capital gain loss. Right, so let's start with the transaction 1. We're told that a manufacturing machine was originally purchased new on 31 July 2017 for 378,500. Was brought into use on the same date in a process of manufacture. The machine was sold to an unconnected company on 15 February 2019 for 563,800. Right, so they sold the machine for 563,800. They had originally bought it at 378,500. Right. Right, so let's start with the manufacturing machine. Right, we have our costs. On 31 July 2017. Which is 378,500. Right. First of all, we need to determine our we have to determine our base cost. Right. Or our tax value, we can determine our tax value. Normally, if there are no complications, like if the asset was bought after 2001, we can simply use our tax value to determine our capital gain. Right. But there will be complications that can be there if the asset is acquired before 2001, as they will now have to determine what to call the valuation date value. Right. Now, this asset was acquired after 2001, so there will be no major complications then. Right. It was bought on 31 July 2017, and we should know that the year ends in February, the year of the company. It is very, very, very important. Right. Number one, the company will only begin to get what we call allowances, tax allowances, from the date that the asset is brought into use. SARS will only grant tax allowances from the date that the asset is brought into use. And we're told that it was brought into use on the same date, on 31 July. So since it was brought into use on 31 July, the first date that they will be getting the allowances, capital allowances, which we did in the previous topic, will be on 28 February 2018. The first financial year after the purchase will be ending on 28 February 2018. Right. So say capital allowances (2018) would be 378,500 multiplied by 40%. Right. If it was a small business corporation, it was going to be 100% in the first year. But this one is not a small business corporation. So if it's not a small business corporation, we'll grant the Section 12C allowance. The Section 12C allowance depends on whether the machine was purchased new or second-hand. If the machine was purchased new, it will be 40% in the first year, 20% in the second year, 20% in the third year, and 20% in the fourth year, which we call the 40-20-20-20 rule. If the asset has been bought second-hand, it will be 20% per annum. Now, this machine, it was purchased new. Because it was purchased new, it will qualify for the accelerated tax allowance of 40% in the first year, then 20 in the second, 20 in the third, and 20 in the fourth year. So in 2018, which is our first year, there will be a tax allowance for 40%. Right. So we would say, so it's very important to check. Thank you. 151,400. It's very important to check if it's a number one, if it's a small business corporation or not, because you know that if it's a small business corporation, we can give 100% if they've got an approved process of manufacture. Then number two, you have to check if it's new or second-hand. I think we did that already. Right. And you should know that Section 12C and Section 12E allowances are not apportioned, like the Section 11 went here. They are not apportioned. So even if they bought in July and our year is ending in February, we won't consider the months. If whenever you're applying Section 12E allowance for small business corporations or Section 12C allowances for companies, you don't have to consider the period. As long as the asset was brought into use, it will qualify for the 40%. Then we'll have our capital allowances in 2019, which will be 378,500. For the next 3 years now, it will be 20%. What do you guess? 75,700. Thank you. Right. Then we get what we call our tax value. So that means according to SARS, on the day that it was sold, this asset was 151,400. And you should note that although this asset was sold in February, I'm not a. I'll just take it. We won't consider the date, although it was sold during the current year. Right. Then another thing, when you sell to a connected person, if you sell to a connected person, it can be a relative or an associate company or a joint venture. Then the proceeds will be determined to be equal to the market value. Right. So now here they sold to an unconnected person, so there are no complications there. So this one is the what? It's the tax value. Then we determine what we call recoupment. Right. Our cost was 378,500. Then our tax value is 151,400. Then okay, so maybe let me be writing here so that when we are alone, you know these things, that our tax value is equal to the cost minus capital allowances, accumulated capital allowances. Learn about special provisions at a later stage for some of the assets. Then our recoupment. Recoupment is the equivalent of what we call profit. I think we dealt with that in the previous topics. That's what that's your cost minus your what? Your tax value. Right. That is if the selling price is above cost. Like when we're dealing with capital gains, normally the selling price is above cost. So your recoupment will be the cost minus tax value. But if you are selling at below cost, then your recoupment will be the selling price minus tax value. I think we learned that in our previous topic. So this formula is applicable only if they are capital gains. That is, if you sell your asset at more than its tax value. Right. So that means here we'll get our recoupment. Right. So this is our recoupment. Normally, your recoupment will be equal to the capital allowances that we claimed. Right. Thank you so much. Right. Then you get what we call your adjusted proceeds. Right. Your adjusted proceeds is the selling price minus recoupment. Right. So now here this manufacturing machine was sold at 563,800. So it was sold at 563,800. So we have our selling price 563,800. Then we then have to subtract our recoupment. We're saying part of the gain is not a capital gain, but it's actually a recoupment of the capital allowances that had been granted by SARS. So our recoupment, we calculated it above, which is 227,100. So then we get what we call the adjusted proceeds. Right. Then you get your capital gain, which is equal to adjusted proceeds minus your base cost. As I said, in this particular case, there are no complications, so our base cost will be equal to the tax value. If there are other complications, like it was bought before 2001, there'll be an issue of determining the valuation date value. Then you add any other additional costs that were incurred after 1 October 2001. That 1 October 2001 date is very, very important because that's when they changed the capital gains tax regime. Right. So that means here our adjusted proceeds which we calculated above 336 700. Right, less our base cost. And I said in this instance, because we don't have any complications, we can take it as our tax value. Right, that's 151 400. Then you get your capital gain. So that will be our capital gain. Any questions there? So that's how we determine our capital gain on this asset. Right. Then we go to transaction 2. Transaction 2. An office building, commercial building, and not used in the manufacturing process, which was purchased on 15 August 2016, was sold on 31 January 2019 for 2,785,000. Right. Then, whilst you are there, you should know that if we've got a commercial building, we know that the deduction will be what? 5% per annum. Is that right? So it will be 5% per annum. Right. So there will be 5% every year. Then so let's determine our parameters here. We would say, okay, they say that was acquired on 15 August 2006. It was sold on 31 January 2019 in the current year for 2,785,000. Right, the cost price were given here. The costs incurred on this building are as follows. Right, you should remember that in the cost of this building, there are some things that we include as part of the cost. Then there are things that are not included as part of the cost. Right, things like the cost price, your transfer duty, your stamp duty, advertising costs to find a seller if you are about to sell, cost of moving your assets, they'll all be included in the cost of the asset. Installation costs, they will be included in the cost of the asset. Then we also have costs that are not supposed to be included. Costs such as borrowing costs like interest, repairs and maintenance, rates and taxes, all those will not be included in the cost of the asset. So if we look at this asset, remember that things like repairs and maintenance, you will have claimed them as a deduction separately. These repairs and maintenance, the interest will not be included in the cost of the asset, because the company will have obtained a Section 11E deduction immediately on those things. Right, but evaluation costs, transfer duty, cost price, we include them. So these are the three that will make up the cost of this asset. Right, so we can say we can determine our cost. Office building. Right, so we'd say we'll calculate our cost price 1,547,000. We have transfer duty, and legal costs. It's 158,000. Valuation costs, we have got 98,000. Interest paid on loan, specifically excluded. When we say they are specifically excluded, we mean there are provisions in the law that specify that we should not include them. Repairs and maintenance, specifically excluded also. Right, so we don't have a so our cost at the end of the day so this will be our cost. Right. This asset was brought into use. Remember that we're in the 2019 year. It was brought into use in the 2007 year. 2007 year, 15 August 2006. Remember, our year is ending in February. So the first year was 2007. We assume that the date of purchase was also the date that it was brought into use. So unless if you are given a different date, you always assume that the purchase date is the date when it was brought into use, unless if they specify that it was brought into use on a different date. Right. So if you check from the 2007 year up to the 2019 year, we've got 12 years. So we'll have building allowances. Would say 1803 times 5% times 12 years. Is it 12? 13. From the 2007 year up to 2019 year. 13 years. Right, so we're counting from here, guys. My 13 is coming from this was in 2006, so the first financial year will be ending 2007 up to the current 2019. And the building allowance, you should also remember that it is not apportioned. The building allowance is not apportioned. Right. What do we get? You said 12. I don't think it's 12. 13. It's 13. Remember the 2007 year, we're counting it. Because remember that it was bought in 2006. So our first year is actually 2007. So that will make it 13 years. Right. So what do we get? Thank you. One 171,950. Right. Then we get our tax base. Right. Then we get our cost, which is 1803. Less our tax base, which is 631,050. We're going to get recoupment.
Sorry, Mr. Eugene.
Yes, my boss.
The 13 there that you multiplied for building, it's for the number of years since we bought it in 2000 and
Yes.
what is it, 2006 up until now. So we have to make a capital allowance for each and every year up until now.
Yes, it's 5% per year.
Oh, okay.
Until it was the time that it was sold.
But why do we use all the 13 years? Why not 1 year? Because we are calculating for 1 year, most.
No, we're not calculating tax allowance. We're calculating the tax, the capital gain on the sale of the asset.
Oh, okay.
If you are calculating if you are calculating a if you are calculating what you call it,
Capital allowance.
capital gain, you have to look at what we're looking for, the tax base of the asset. Is that right? We're looking for the tax base of the asset. So the tax base of the asset, remember what we said here. I think I gave you the formula here. I said your tax base is the cost minus accumulated what? Capital allowances. Am I right?
Oh, okay.
So accumulated capital allowances, it means all the capital allowances from the day that you bought the asset until the current year.
Oh, all right.
Remember that the capital gains you only get, they will only be there the year that you sell. You might sell after 6 years, after 7 years. But when you are selling now, we need to determine what is the tax value of that asset by the time that you are selling. So that tax value is the cost minus accumulated tax allowances. Right.
No,
so
it's clear. Thank you.
Okay, thank you, sir. Then the recoupment is that one. Is that right? Then we would have our what? Our proceeds. We get our proceeds are 2,785,000. Then we have our recoupment, which we calculated up there. Right. Then we get our what? Adjusted proceeds. I gave you the formula earlier on. Which would be equal to, right. Then our adjusted proceeds, which is 1613050, less the what? The tax base, the base cost. Which is 631,050. Will give us our capital gain. Right. Then we get our total capital gain. We then add the capital gains from all our assets that we have, even if they are 10. So we'll have our sum. We're starting here, remember, up to here. I think something happened on my formula there. Can I just sort this out? Right. Then we are told that last year in 2018, a rain day, a private limited assessed capital loss brought forward from the previous year of assessment is 23,000. So you have to subtract the assessed loss brought forward. If you have got any capital gains, you can roll over. You can subtract any rolled over assessed loss. Right. Which is 23,000. You get what we call your net capital gain. Right. Then you get your taxable capital gain. Which is 1,144,300 multiplied by 80%. Only 80% will be taxed. What do we get? So this will be our taxable capital gains. Thank you so much. So that means these will be the taxable capital gains that will be included in the calculation of the income tax for the year. Any questions there? All right. If we don't have any questions, then we'll go to the next one.
Yeah, there is a question, sir.
Oh, sorry.
Yes.
I wanted to find out in terms of the 80%, are we told or it's a standard percentage that we are supposed to know?
That's according to the Act.
Okay.
Actually, they give you, I think, if you can check, the tax rates, most of the, for this module, you don't have to mainly claim most of them, because at the end of the paper, they usually, this one did not give, don't know what I mean, but normally you find that at the end of the paper, they will tell you, but it's 80%. The taxable capital gain for companies, it's 80%.
Okay.
Normally you'd find that in your papers, they will give you the tax rates and everything at the back of the paper. Right, any other questions? Okay, so let's look at the next one. Question 2, part A. Right. A card specialist private limited, Arcade S develops and manufactures arcade game machines. The process is regarded by SARS as a process of manufacture. The company is not a small business corporation as defined in the Income Tax Act, and its year of assessment ends on the last day of February. Remember, the differences between a normal company and that one that is a small business corporation is mainly on the capital allowances, whereby a small business corporation can have the section 12E allowances. Then number 2, the tax tables that they use. For a company, it's a normal company is strictly 28%, but for a small business corporation, they've got tables that they use. Right. Arcade S is a registered value-added tax vendor. All amounts exclude VAT unless specifically stated otherwise. Right, for a VAT vendor, you know that the transactions we'll always exclude VAT when we're calculating the normal tax. Right. We were supposed to calculate the income tax liability for arcade specialists for the 2019 year of assessment. Provide brief reasons for adjusting or not adjusting each of the accounting transactions. So we'll now be using the principles that we've learned over the past topics. Remember that when we're doing those topics, we just have to determine the amounts that are taxable, amounts that are deductible, and how do we determine those deductions. But then they can be consolidated in one, whereby they say do a calculation of the tax that is to be paid by the company. So we simply have to include all taxable incomes and subtract all allowable deductions. Right. So we have our calculation there. Calculation of income tax liability of tax specialists. Private Limited for the 2019 year of assessment. Right. Normally, I like to just provide when I start to just provide for 3 columns, but even 2 can work. The first 2, they might be necessary to make calculations. There might be some calculations that might need to be made. So you can provide for 2 to 3, but in most exams 2 will be fit, but you just provide for 3 in case. Right. So these ones will be the calculations, then whatever final answer you get, the taxable income or deductible amount, you put it in the 3rd column. Right. We have sales. If there is no story, take it as it is. If there is no story, you just take it as it is, as long as it's supposed to be included. So our sales, there's no number here, there's no note. So that means that that's our sales. Because normally everything that is provided on the additional information will have a note there. So you first have to read the note. So we have our sales. They'll go straight to the 3rd column since there's nothing there. 5,878,251. Right. Then we are given our cost of sales. Now there's a note number 1. So you have to go and read note number 1. Cost of sales consisted of the following. Right. The opening stock. Remember that our stock, there are various issues that can be accounted for under the stock. Number 1, did they say we should start with profit before tax? If they say start from profit before tax, we should start from profit. Oh, they said comment your
Yes, they
calculation
said
from
that.
profit before tax. So that we should start from there. There's a difference there. I will explain. Right. If you are starting from sales, if you are starting from including everything, that means you just take the things that are relevant. Is that right? But if they say start from profit before tax, it means those things that are above there have been included in the calculation. So you are supposed to what you only do if you are starting from profit before tax is to include omissions and reverse errors. Include omissions and reverse any errors. But if you are starting from sales, you just include everything as it is supposed to be done. That means a taxable income, you just edit, a taxable expense, you subtract it. But if you are starting from profit before tax, you are supposed to add any omissions, take them into account. When we say add them, I don't mean adding in terms of plus. If it's an expense, you subtract it. If it's an income, you will have to add it. So you have to check any omissions and then adjust for them. Then if there are any errors, you have to correct them. Right. So here we have cost of sales consisted of the following. These are the things that gave us this figure. Then they said the market value of closing stock was 1645357. Right. We should know that the tax laws, they also follow what we do when we are using IFRS. That is, a stock should be recorded at the lower of cost and net realizable value. Right. So if the closing inventory has got a cost of 1674, which is more than the market value of the closing inventory was 1645. So you can see that the market value is lower than the cost. So that means we have to reverse that. Instead, we should use this closing stock, which is lower than this one that they used. So inventory should always be recorded at the lower of a cost and net realizable value. So we're saying we would come here and say closing inventory right, we're saying should have been included at the lower market value. So we make the adjustment. There are two ways. If in an exam, the faster way is to just calculate and say 1674 536 minus 1645 357. What do we get? I think I got someone sent that answer already. 29179. When you reduce your closing inventory, your taxable income will also reduce. Your taxable income will also reduce. If it was opening inventory, it was going to be the opposite. We're going to add. Right? The other way was for you to add back the one it cost, which is that is to subtract the one it cost, which is 1674 536, and then add on a separate line 1645 357. So you could also do the same by reversing the wrong one and then recording the correct one. That will also be correct. Or you can just find the difference like that. So you should be very careful if you are dealing with you are starting from profit before tax, because you should know that when we reduce our closing inventory, our taxable income also reduces. If we increase our taxable income, then if we increase our closing inventory, our taxable income also increases. But for opening inventory, is the opposite. If you increase the opening inventory, your taxable income will reduce. So if this was opening inventory, actually this was going to be a plus here. Right? Any questions on the inventory? Right, we'll go to number 2. The rental received 575,250. Number 2. The company received the rental of 575,250 for renting out arcade game machines to various arcade game venues in South Africa. Right. If they rent these machines and receive income, there's nothing wrong about including that amount in income, isn't it? So there's nothing wrong about that. Then number 3, arcades, SAS. So that means this one was correctly included. They were correct to include it, and it's already included. So there's no need to adjust. We just leave it like that. Or maybe we can say, because normally they want us to include all items, we can say rental Because I saw somewhere where they said what? Let me just check. Oh, they said provide brief reasons for adjusting or not adjusting each of the accounting transactions. Right. So we can say rental income that's included income, or we can say taxable. So no adjustment. No adjustment. It all depends on whether it is taxable or not. Foreign income, if there's a foreign an agreement, double taxation agreement, then it will not be taxable. So foreign income where there's a double taxation agreement will not be taxable. But if there's no double taxation agreement, it will be still taxable. Right? So normally they tell you those things. Right? Arcade received an amount of 230,000 from a dividend from SA company. Right? Local dividends are supposed to be exempt. They are not subject to income tax. They are separately subject to dividend tax. So when we calculate tax, any dividends that are received locally, they will not be taxable. So that's 237.50. It has to be subtracted. They added it. So we have to reverse that. So we subtract it because it had been added here together with this 806,000. They had added it to the taxable income. So you have to reverse it by subtracting it. So if we're answering the other way, the dividend we're just going to say 0. Because that could have meant that it's not taxable if we're starting from the sales. So you should be very careful there. Right. Then number 4, contribution to pension fund, 118,500. The contribution of 118,500 towards the pension fund was in respect of all employees. Contribution to pension fund if you contribute towards the pension fund towards your employees, then that amount will be fully deductible, so no adjustment. So it was not, it was correct to include that amount, so there will be no adjustment to that. All contributions made on behalf of employees, they will be deductible. I think when we deal with an annuity, that's when we talked about those things about annuity and stuff like that. A provision for doubtful debts, 9287. Right, the accounting provision for doubtful debts is 92,870 for the 2019 year of assessment. The list of doubtful debts amounted to 194,000 in 2018 and 225,400 in 2019. Right. If we are not told anything else, we know that SARS will only allow 25% of the list of doubtful debts. So we can say the best way to present this, we can say provision for doubtful debts accounting would then subtract that 92,870. Right, then we instead we add back, sorry, because it had been subtracted. Then we put our allowance for credit losses which is SARS, which will be the 92,870 times 25%. What do we get? Two, 3, 2, 1, 8. Thank you. Right. So, but you should be very careful. Sometimes they will tell you that if they are not applying, they can give you a data schedule. If they are not applying, if it's 9, then you know that if the dates are 120 days or more, we use the 40%. Then if they are less than 120 days, then we use the 25%. So you should be very careful there if you are given the data schedule. Right, research and development, 535250. Arcade S has done extensive research to develop an arcade game machine that is based on the movie Gladiators. An amount of 249,750 was paid on 1 June 2018, and another amount of 285,500 was paid on 1 December 2018. So the other one was on 1 June 2018, the other one on 1 December 2018. Right. Let's see, let's just check. I want to check our financial year when it ends. February. So it started on, and our year is 2019. So it started on 1 March 2018. 1 March 2018. And this was paid on 1 June 2018 and 1 December 2018. They were all paid during the current financial year. Right, the approval of the research and development was received by the Minister of Science and Technology on 15 December 2018. Both amounts paid relating to operating expenditure, that means the requirements of section 11D. Right, so here they subtracted the full 35. So that was correct. All these expenditures were incurred before the approval was reached. So they don't qualify for the 150% deduction. But if the approval they had been incurred after the approval, then we're going to deduct 150% of the research expenditure. Remember that if you are you undertake a research that is approved by the minister, as long as you have obtained the approval, except capital assets, then there will be a deduction. You will be entitled to a deduction of 150% of the expenditure incurred. So in this case, all the expenditure was incurred before the approval. So would say research and expenditure. Then we can say expenditure incurred before minister's approval. Means no 150% deduction. So we're saying no adjustment here. So there was nothing wrong in subtracting it as it is. Okay. Okay, she's talking about salaries. Salaries. Employee costs fully deductible. what someone is asking a question here, said 0.5, do we include 225,500 in 2019? Let's see. Remember that they include the movement. They include the movement. For the allowance, we include the movement from 194 to 225. That's the 92 here. Is what the list of doubtful debts. There's something there that is, they said what, 92,870. No. I think I'd not seen that one. I thought this 92 is the difference between these two, of which it's not. It's not. So we have to correct that. Sorry, Swongile. Right. So what we have to do here, sorry about that allowance. Instead of doing this, we are supposed to look at the difference between the two. I thought the 92, they calculated it as the difference. So I would say a 92 would say the difference between those two figures, that is 225,400 minus 194,000 times 25%. Alternatively, you can add the one for last year. You can just say the one for last year, 194,000 times 25%, you add. Then the one for this year, 225,400 times 25%, you subtract. 7,850. Thank you so much. Thank you for correcting this one. I had just taken it for granted that the 92 was the difference that was included by accounting. Sorry for that. Right, the salaries are fully deductible there. So I said the alternative way, you can just add the allowance for last year and then subtract the allowance for this year. Right, then the next thing, legal expenses number 7. Legal expenses were incurred as follows. Remember that legal expenses, they said what? Legal costs relating to the collecting of outstanding debtors, 11,340. Then legal costs paid on behalf of one of the company's employees regarding a company-related issue, 7,410. Right, if you pay legal costs that are for the purposes of the trade, then you can claim the deduction. But if the legal costs are paid on something that is not related to trade, for example, if you give a loan to an employee and you incur legal costs of recovering that debt, that will not be included in our expenses. So these legal expenses, if you can look at both of them, they are relating to the trade. So the first one is collecting outstanding debtors of the entity. Then the second one, the matter is regarding the company related issue. So we can say these legal expenses are for the purposes of trade. Therefore, they will be fully deductible. So we can say for the purposes of trade, it's fully deductible. So we'll have no adjustment there. But if this paid to the employee had nothing to do with the business, then we're going to say it's not deductible. But here they say that regarding a company-related issue. That's why we could allow that deduction. Right. Then depreciation. Depreciation, I think you just say, you know that our depreciation policies in accounting are usually different from SARS. So the depreciation, we simply have to add it back, 350,280. So we'd say depreciation $350,280. We add it back, then we provide the allowances according to SARS. Then we provide the allowances according to SARS. Right. So we go to number 8. Right. A depreciation relates to the following assets. Machine K, a machine used directly in the manufacturing process, was purchased new for an amount of 517,500, including VAT, on 1 June 2018. You have to be very careful with your dates. We know that this is not a small business corporation, number one, so they will qualify for the 40 2020 if it was purchased new, like in this case. Right, and it was bought during the current year. 1 June 2018 falls into the 2019 year. Remember, our year is ending in February. So it was brought into use on the same date, but our costs should exclude VAT. So we'd say section 12C allowance on machinery would say 517,500 multiplied by 100 divided by 115, because the cost should exclude VAT. Then multiply by what? 40% in the first year. What do we get? Thank you. $180,000. Right. Then we've got a new computer, which is used for running the business, was purchased for an amount of 45,500. Right. On that machine, if it was a small business corporation, it was going to be 100%. And another thing, section 12C allowance is not apportioned. That's why you saw I didn't even look at 1 June 2018. Right. Section 12E and section 12C allowances are not apportioned. Oh, thank you so much. I was supposed to subtract this 188 in allowance. Right. Then we have got this new computer, which is used for running the business, was purchased for an amount of 45,500 on 1 August and brought into use on 1 October 2018. If it was a small business corporation, it was going to be 50%. Remember, all other assets other than manufacturing machinery in a small business corporation, it will be 50% in the first year, 30% second, and 20% third year, not apportioned. But since this is not a small business corporation, we'll use what we call the binding general ruling. I think if the gentleman who was asking me about the binding general ruling, it's given by SARS. So it lists the write-off periods. So for computers here is 3 years. And all those were in tier through the binding general ruling, we are supposed to use, we apportion them. So it was bought on 1 August. We have to take into account, in fact, it was bought on 1 August, but was brought into use on 1 October. SARS will only grant allowances from the day that the asset is brought into use. So we'll count our period from October. Well, that's October up to February, which is 5 months. So we'd say, went here on computer, would say 45,500 divided by 3, multiply by, from October until February, 5 divided by 12. What do we get? $6,319. Right. Please, when you are not dealing with a small business corporation, know that all other assets other than buildings and manufacturing machinery for an approved process of manufacture, you will be apportioning the allowance. Right. Then we've got a delivery truck was purchased for 410,000 on 1 October 2017 for making deliveries to clients and brought into use on 1 November 2017. Another thing, our allowances, they are only provided from the date that the asset is brought into use. Right, the delivery truck was damaged beyond repair in an accident on 1 February 2019, and the insurer paid an amount of 420,000 to Arcade S on 26 February 2019. Right, so we have to determine our recoupment, and there might be capital gains. You'd find that in some questions they will tell you that ignore capital gains if you're just calculating the income tax, but here they didn't say ignore, so we have to take that into account. So it was purchased for 410,000. So we'd say cost. Okay, so let me just deliver the truck. Our cost that's on 1 October 2017 is for 10,000. Right. Then we'll have wear and tear 2018. Right. Remember that according to the binding general ruling, the delivery vehicle they are saying is 4 years, and it was brought into use on 1 November. So in 2018, it was only used for 4 months, 1 November to February. Right. So we'd say 4 months. So we'd say the cost for 10,000 divided by 4, which is for the number of years according to the binding general ruling, times 4 the number of months divided by 12. What do we get? 34167. Right. Then we get our wear and tear. (2019). We'll have for 10,000 divided by 4, multiplied by, right. It was sold on 1 February 2019. That means during the current year, we used it for 11 months. Remember, our year is starting in March and ending in February. So we used it for 11 months. So we'd multiply by 11 divided by 12. What do we get? 93958. So we'll have 93958. And we'll also subtract it on our calculation of the our taxable income, because it is for this year. This one I didn't subtract it because it was for 2018. Right. Then we get our.
So, Mr. Eugene,
Yes, boss.
the ones for the previous years of which are not applicable to this year, do we need to show them since that we are not getting marks for them?
Remember, you need to calculate your recoupment.
Also, we must show them.
Yes, because for you can't calculate the recoupment without them. We're not yet done. Remember, when you sell an asset, you have to determine recoupment. For you to determine recoupment, you need your tax base. So they are needed.
Oh, all right.
Because if we don't show your calculations, then because we need this figure that I'm calculating here. So for you to only get it, you should also do the previous years. But only that for the previous years, we're not going to go year by year. If they were 5 years, we're just going to bunch them. But the one for this year is the one that we're supposed to put separately so that we can incorporate it here. Right. Then we have our cost, which is a 281 for 10,000 less our tax base. We get we get our recoupment. So here you'll be using that figure now. So you would need that. Recoupment is included in your taxable income. Right. Then we'll have our proceeds, which is for 20,000, which we got from the insurance. Then we have our recoupment, like this is exactly like what we're doing in the other question. We get what? Our adjusted proceeds. Then we'll have adjusted proceeds, right? Then we subtract our base cost, which is equivalent to our tax value in this case. Capital gain. Right. Then taxable capital gain. Remember that it's 80%. Not all the capital gain will be taxed. There's a non-taxable portion of which will be 8,000. Any questions there? No, capital gain is only charged on 80% of the capital gain, not of the proceeds. 80% of the capital gain will be taxed for income tax purposes. Not 80% of the proceeds. 80% of the capital gain. This 10,000. So that is the one that will be included in your income tax. I hope you answered. Thank you. Right. Then that's it. Then you get your taxable income. Sorry. So that's your taxable income. Then you get your income tax liability. To get your income tax liability, you multiply the taxable income times the tax rate. And you should be very careful. In your exams, they can use the new one, but they've been using, so far we've been using the 28%. But there's a possibility that you can even get the new one, which is the 27%. So you should check the one that is applicable. So that would be our taxable income. Any questions?
Yeah, I'm seeing somewhere you wrote fully deductible, but I don't see the figures aligned to that transaction.
Which one?
For instance, let me just go back to salaries.
Yes, because remember that they are already included in the calculation of this profit. We said salaries, they are fully deductible, so there's no need to adjust. Remember that we started from the profit that was already calculated. So if something is supposed to be included, then we don't have to include the figure because it's already within this 2191. We're only dealing with those things that they made errors which were included, which was not supposed to be included, and omissions only.
So do you mean they won't influence the balance?
They're already in
Taxable
there, is that
income.
they're already included in the 2191. Remember that the 2191 is coming from here, say. Here. This is where the 2191 is coming from. They're already included in the calculation, this calculation here. They're already there.
Oh, yeah.
So here, when I was doing the calculation now, I just stated why we are not including. That's why there's no figure here, if you can see. They were already deducted when they calculated this 2191. So we're only interested in things that were included, which were not supposed to be included. So if you are starting from the profit before tax, all the things that were included correctly, they are not an issue. You don't have to adjust them. You don't have to include them. Your issues are those things that were included, which were not supposed to be included, and those things that were not included, which were supposed to be included. So actually, it's errors and omissions that we're concentrating on. But if we're doing the other way of starting from sales, otherwise the ones that we included were the ones that we're going to subtract, except the last was the tax allowances there. That could have made that things like the dividend that we included, these ones we're going to not to include them. We're only going to concentrate on the relevant items. Any
Makes
questions?
sense.
Right. Our next question. A arcade specialist is considering the payment of a restraint of trade payment to John McQuena, one of the electronic engineers working on the new range of arcade machines for the export market. John McQuena has accepted an offer from a competitor, and Arcade Specialists Private Limited is concerned about the trade secret and the intellectual capital embedded in the new range of arcade machines. One way of ensuring the protection of the trade secret and intellectual capital for Arcade Specialists Private Limited is to offer. Yeah, I was supposed to include it. It's only that I was alerted later, Mtandeni. So you can just include the sales and say not adjusted because it's flexible. Right. One way of ensuring the protection of the trade secret and intellectual capital of Arcade Specialists is to offer a restraint of trade payment of 550,000 to John McQuena for a period of 4 years, effective from 1 December 2018, the date on which John McQuena will resign from the service of Arcade Specialists Private Limited. The full amount will be taxable in the hands of John McQuena for 2019 tax year. Discussed, supported by the necessary calculations if the 550 paid as a restraint of trade payment will be allowed as an income tax deduction for the 2019 year of assessment. Right. We did that. Right. Restraint of trade. Right. A restraint of trade is deductible over the years of the restraint. Or 3 years, whichever is lower. Right. Effectively, we know that a restraint of trade, as long as the years are 3 or more, you allocate it over 3 years. And as long, over the actual number of years. But if the years are less than 3, then we use 3. Right. So we're saying 550,000 divided by 4. What do we get? And remember that it is not apportioned. What do we get? 137,500. Thank you, guys. So we can say during the 2019 financial year, only 137,500 would be deductible for tax purposes. Right, and another thing, you should know that one of the conditions for this amount to be deductible, it should be included in the taxable income in the hands of the receiver. So here they are saying it's included. If they said it is not included, then we're going to say it's not deductible, considering that it's not included in the taxable income of the receiver, of the recipient. So in this case, then the company will be able to claim this amount that we've talked about here, which is the 137,500. Any questions? Right. Okay.
Yeah, sir, this
Yes.
question is 3 hours. Do they give us the time
I can't hear you.
upload? This paper is 3 hours. Do they give us time for uploading?
Yes. The time of upload, there will be 30 minutes for uploading. After finishing, the 3 hours is for writing.
Yeah.
So the 3 hours will be just before writing time. Then you get 30 minutes extra for the uploading.
Hey, let's pray for no load shedding.
I can't hear you.
I was saying let's pray for no load shedding during that period.
Yeah, you have to make also, you should also make sure that you are at a place where maybe you have checked the schedules and where power, you know, that is usually safer. Like if you know that your workplace is usually good in terms of power, it's rather better to be at your workplace. But provided also you know that you are writing using the Invigilator app, there should be not be too much noise. Right. Okay, my friends. By my clock, it's around 12 minutes to 5. Can we just take about 10-minute break? Let's say by 5 o'clock we start, and then we just push whatever we can up to 6 o'clock. So I'll give you a 10-minute break. Then we'll finish it around 6. So I'm not going to go out, so you can still use the same link. You can also mute yourself so that we don't hear you much there. Thank you so much. So we'll continue at 5. Right, we'll go to question 3. Right. Sleep Limited is a guest house situated in Centurion, Pretoria, that provides accommodation and breakfast to guests. Sleep Limit is registered for value-added tax and there's a 2-month tax period. Listed below are transactions that occurred during May and June 2018. All amounts are inclusive of VAT unless otherwise stated. Right, calculate the VAT payable or refundable to Sleep Limited for the 2-month tax period ending 30 June 2018. When an amount is new, please indicate and supply a brief reason. So the 2-month period is ending on 30 June 2018. So we are basically dealing with the, remember that is 2 months, that's May and June. Calculation of payable or refundable. All right. Normally, we'll have our VAT output. And we'll have our VAT inputs. In general terms, VAT output is usually on charges that we make against customers, and VAT input is on what we charge, what we are charged by our own suppliers. Of course, there are other variations there where we have got those things like deemed VAT, fringe benefits, where we talk about the BLNS countries and all those things. There will be another issue there which might deviate from my definition that I just talked about. Right. So now let's calculate our VAT. Now you should, when you are calculating the VAT, one thing that you should be very careful about is if they say the amounts are inclusive. For you to calculate your VAT, you would multiply by 15 over 115. And if they are exclusive, you have to multiply by 15%. Right. So let's look at this. So they're saying sleep charge is 920 excluding VAT per person per night for accommodation and breakfast during May and June. Sleep accommodated 20 guests who each stayed for 2 nights. All right, they each 20 guests, they stayed for 2 nights, and they charged 920 per person per night. Right. So if the stay is less than 28 days, they will be the charge VAT. They charge VAT on the full amount. But if the stay is more than 28 days, we'll then use our limit of 60 days when talking about this VAT. Right. So we can say is for accommodation and breakfast. So say 920, right? And these are 20 guests. And these 20 guests stayed for 2 nights each. Right, the amount is excluding VAT, so we multiply by 15% to get the VAT. What do you get? So 920 is the charge per night per person. 20 is the number of guests. 2 is the number of nights that each guest stayed. Now they stayed 2 nights, which is less than 28 days. So we'll just include the normal VAT. And because the amount excludes VAT, we'll multiply by 15%. Any questions there? Right. 4 guests who usually reside in Modimole, but sometimes work in Centurion for a period of time during the stay. The year stayed in the guest house for 36 nights during May and June 2018. Sleep charged these 4 guests a special rate of 750 excluding VAT per person per night. Right. So these ones are going to say fee for accommodation again. This one is 750. Right. And these ones, they are 4 people. Each person stayed for 36 nights. The amount is excluding VAT, so it will be 15% again. But because it's more than 28 days, we'll have to apply our 60%. If the days are more than 28 days, then we apply the 60%. What do we get? $9,720. Thank you. Right. A Zlip purchased food for 32,150. 70% of these foods relate to meals provided to guests at Zlip, right? So this will go on the VAT input. Meals for guests right. We are going to say 32,150 times 70%. Remember, they said, I want you to see here, they said all amounts are inclusive of VAT unless told otherwise. So here where they didn't specify, would assume that it's inclusive of VAT. So if it's inclusive of VAT, to calculate our VAT, we multiply by 15 divided by 115. Right. Then the other figure, the other 30% was for meals and refreshments for cleaning staff. Meals and refreshments for cleaning staff. This is considered entertainment. But if the organization, for example, is running a canteen whereby they provide food to the employees, then they can claim VAT on that. Right. So in fact, you can go on, go further and say VAT input denied. Right, salaries related to kitchen and cleaning staff amounted to 12,450, and water and electricity account amounted to 5,640. Salaries, not a supply. So there's no VAT on salaries because it is not considered a supply. Water and electricity, there will be VAT. $5,640 times 15 divided by 115. 736. Thank you. So salaries, there's no VAT, but the water and electricity there is. Right. Zlip received a payment of 8,700 in advance from Mr. Kumalo that will be staying in the guest house for a few nights during July 2018. Remember that there are two ways in which you can be registered for VAT, either on an invoice basis or on the payments basis. So if you are registered on an invoice basis, the VAT, the time of providing the service will be the earlier of the payment of the amount of the receipt. So here the receipt happens earlier. So although the stay will be in July, this amount will be subject to VAT. So you can say, see, let me just call it Kumalo. That will be 8,700 times 15 divided by 115. They say that you'll be staying for a few nights. So we assume that that will be less than 28. What do we get? 1135. Right. On 5 May 2018, Zlip commenced the plans for renovations in the guest house. Each room was to be remodeled, and Zlip borrowed 8,000 from Money Bank to finance the remodeling. The remodeling activities commenced on 5 July. Right. Borrowed funds. Exempt. Financial services. So loans, interest, there will be no VAT there. Right. On 25 June 2018, Zlip purchased a second-hand oven and refrigeration from a non-vendor for use in the guest house kitchen. Right. The total purchase price of the two items was 18,700, and the market value was 21,300. Right. There will be what we call deemed input VAT. Deemed input VAT, and that deemed input VAT will be applied on the lesser of the cost and market value. So we would apply it on the lesser, which is the purchase price, which is 18,700. Right. So we can say so as long as you pay a second-hand product from a non-vendor, second-hand oven and refrigerator. So we have deemed input VAT. There is deemed input VAT, and we know that we have to use lower of cost and net and market value. So in this case, the lower value is the cost 18,700. And remember our rule that we also say that to the extent that payment was made. So if maybe they not yet paid part of the amount, then they could only claim, or let's say they paid only 10,000, then we're going to use only 10,000. Right. For this one, whether they say the amounts are inclusive or exclusive, we always use 15/115. We always use 15/115 for the second-hand goods, because the amount is always considered to be inclusive of VAT. So this one is a general rule. Whether they say the amounts are including or excluding, for this one you always include the VAT. You always use the 15/115. Right. Zlip paid an amount of 4,280 to multiple choice for the monthly DSTV subscription, a service provided to the guests, as well as 7,640 to ABC Bank for bank charges. Right. DSTV subscription. Right, we have 4,280 multiplied by 15 divided by 115. What do we get? 558. Thank you. Bank charges. There is VAT on bank charges, but things like interest, we don't have VAT on interest. 7,640. The bank charges, they said that they are excluding VAT. So this one, you are not multiplying by 15/115. You are multiplying by 15% straight. You use the 15%. Is that right? To get the 1146. Okay. So on this one, we don't use the 15/115 because we were told that it's excluding VAT. So those are the items. Then we get our total VAT output. we get then we get total VAT input. Right, the VAT output is more than the VAT input. So we have a VAT payable. If your VAT output is more than the VAT input, there will be VAT payable. But if it's the other way around, if VAT input is more than the VAT output, there will be VAT receivable. So that means for this period, the company should pay to SARS. They should pay to SARS 8,561. Right. Any questions? Seven, eight. Yes, you can just say VAT payable, then that's fine. Or it's plus. Oh, thank you so much. Right. Now, the next part, a Sleep Limited is considering purchasing a vehicle for the guest house. They've determined that there's a need to be able to transport guests to and from Gautrain station in Centurion. Sleep would like to purchase an 8-seater minibus for this purpose. Right. Now they are saying, number one, briefly advise Sleep Limited what the VAT implications of acquiring the 8-seated minibus will be. Now remember that if you acquire a vehicle, we have to determine whether the vehicle is a motor car or not. Right. So now, according to the Act, a motor car will include a motor vehicle, station wagon, a minibus, double cab, light delivery vehicle, or any other vehicle used on public roads that is 3 or more wheels, and which is constructed mainly for the carriage of passengers. Right. So this vehicle will be regarded as a motor car. So we would say that part B, Right. The motor car is a, so the minibus is a motor car is defined. Hence, VAT input will be denied. So VAT input will be denied. So the company will not claim input VAT, even if the VAT is charged by the supplier. Any questions? Right. Then next is Sleep Limited submits their VAT returns via SARS e-filing and makes a payment via an electronic bank transfer. Right. The payment is not initiated on e-filing. The payment is not initiated on e-filing, by which date must they submit VAT 201 return and payment for the 2 months, 2-month tax period ending on 30 June. Assume they owe 10,300. Right. So remember that normally it's on the 25th, unless if you are submitting your returns via e-filing, and you are also making the payment via e-filing. So unless if you are submitting returns via e-filing and you are also paying via the system, that could be you could pay on the last day of the month. Right. But if you are not, then you have to pay by the 25th. Now these guys they've filed their returns via the e-filing system, but they don't make the payment via the e-filing system. They pay via in EFT, right? So what will happen in this particular case? They should pay by the 25th of next month. So would say 25 July 2018. But if they were also paying via e-filing, then it was going to be 31 July, the last business day. If 31 is not on a weekend, because it has to be the last business day of the month. Right. Right. What are the consequences of submitting their return on time, but then they make the payment on the 7th of August? Right. So here that means they are although the return is provided on time, but the payment is being delayed. Right. There will be a penalty. Right. So we're saying there is usually a penalty there is a penalty of 10% of the amount owed, and interest can be charged at this prescribed rate. So if you fail to pay on time, there can be a penalty. Right, any questions there? Right. Number 4, Best Clean Limited is a domestic cleaning business operating in Cape Town, South Africa, and is not a small business corporation as defined in the Income Tax Act. Best Clean's year of assessment ends on the last day of March. Right. Then on number 1, it says calculate the first provision of tax payment of Best Clean Limited for the 2019 year of assessment. Provide brief reasons for selecting or not selecting a particular basic amount and clearly state on which date the payment must be made. Right, this entity's financial year is ending in March 2019. Remember that the first provision of tax payment is supposed to be paid when you 6 months into the year. That means their year is starting April. So you'd find that they should pay by 30 September. Is that right? So let's look at the first provision of tax payment. First provisional tax payments. Right, this is to be paid by 30 September. Actually, they asked that we should also show it. 2018. The second will be paid at end of year on 31 March. Right. Remember that we cannot use an assessment that was received within 14 days from the date of payment. So we cannot use an assessment that was received on 16 September or earlier. So we have to go back and check when first of all, we try to use the 2018 assessment. If it cannot be used, we go to the 2017. If it cannot be used, we go to the 2016, on and on like that. Right, the actual taxable income for the 2019 year of assessment was calculated to be 3,329,580 on 30 April 2019. So we cannot use that that one, because remember that the 2019 by 30 September, we don't have it yet. The company was issued with a 2018 income tax assessment on 25 September 2018. Right, we are paying on 30 September 2018. So the 2018 assessment cannot be used since we received it within 14 days of the payment. 25 September, that's about 5 days before the payment. So the 2018, we are supposed to state that 2018 cannot be used. 2018 assessments cannot be used as it was received within 14 days. Of the date of payment. Right, so we cannot use it to determine the basic amount. Right, then the 2017 income tax assessment was issued on 28 August 2017, and it reflected a taxable income of 2,901. Included in this taxable income is a taxable capital gain of 57,250. Right. So we can say 2017 can be used. It was received more than 14 days and it was available on the date of payment. Is that right? Then I saw they gave us 2016, so we can say 2016. Or maybe I should start with 2016 because we're not going to use it. Or maybe let me just write it here. 2016 cannot be used since 2017 is available. We use the latest, which is available. Right, so we should use 2017. So our basic amount will be based on 2017. Right. So would say 2017 taxable income. We have that was 290,135. Right. Then we have to subtract capital gains. It should exclude capital gains. Remember, capital gains, they exclude them because they are not recurring. 57,250. Right. What will you get there? We'll get our, sorry. Right. Then we also have to check if we are going to need an adjustment. We have to check if we would need an adjustment. Right. An adjustment would normally be required if the assessment is for more than a year before the current year. So we have to check that was it the assessment that we're looking at, is it more than a year? So there will be an 8% adjustment for each year. And we also have to check, is it more than 18 months from the date that we are getting the assessment for us to adjust for an 8% adjustment per annum. And that 8% per adjustment is not compounded. Right. So now, the 2017 year of assessment ended on 31 March 2017. And we are doing this assessment on 30 September, which is about 18 months, which is not more than 18 months. So it's not more than 18 months, so there's no adjustment. So no adjustment. Since the estimate is made not more than 18 months. After the end of the used year of assessment. So we're saying the 2017 year ended in March 2017. And this payment is being made on 30 September, which is exactly 18 months. It's not more than 18 months. But if we reduce the 2016 assessment, we're going to adjust with 8% per year. Right. So in this case, we don't adjust. So that means this will be our basic amount that we're going to use for tax purposes. Right. To calculate our provisional tax payment, would then calculate our estimated tax on that amount. Remember that this is not a small business corporation. If it was a small business corporation, would use the tables of the small business corporation, right? So would say income tax on basic amount 28% multiplied by 2,844,100. What do you get? We get 796. Then our first provisional tax payment. Remember that first provisional tax payment will only be 50%. Our first provisional tax payment will be 50% of the tax payable on the basic amount. So 50% times 796, 348. Thank you. So that's it. So they are supposed to pay 398,174 on the first provisional tax payment. So you should check your debts. Is it within 18 months? If it was more than 18 months, we're going to adjust with 8% per year. Any questions? Right. Then calculate the third. They said what? Calculate the third provisional tax payment of clean for the 2019 year of assessment and clearly state on which date the payment must be made to SARS. Assume that the second provisional tax payment was 435. Right. If you are calculating the third provisional tax payment, you now have received the actual taxable income here, which is this one. Right. So we'll have would say third provisional tax payments 50%. I think there's a mistyping here. This is 50%. What about that? Right. Actual taxable income. Right. We'll have we said, right, the actual taxable income is 332958. Right, we'll have the tax on taxable income. Would say 329,580 times 28%. Right. Then less first provisional tax payment which is this one that we calculated. I think there was a mistake there on the 93282. Maybe we left out the two, the other last one. Then less second provisional tax payments. Right, that one we say they told us that we should assume the one that we are given. Right, would say they said that we should assume that it's 45,000. Assume that the second provisional tax payment is 45,000. Right. Right. Then we get our third provisional tax payment. Right. So that will be the third provisional tax payment before the company receives the final tax assessment from us. Remember, this is the first one, which you make 6 months into the year. Then you have the second one, which you make within that means at the end of the year. Then there's the when you have verified your actual income tax payable, then you make the third one. Then you wait for the final assessment. Any questions? Right. So then you can at your own time you can do the last one. I think we did that many times. Discuss whether the amount is deductible. Remember, you have to do your test whether the company is carrying on a trade, whether there is an expenditure or a loss. Was it during the year of assessment? Was it in the production of income? Then is it not of a capital nature? Then you check if there is any section 23 prohibition. Then you conclude whether the amount is deductible. And they said we should include relevant case law. So you can also use the case law that we did a lot of that. And these objective factors, we also have them when we're doing the capital nature. Any questions before I close the session? Okay, very sorry for disturbing your Sunday. So please, you can just revise. You can, those who are, especially those who are writing, you can try to do the other paper. If you've got any questions, you can be able to ask me. And for those who are doing TAX3761, please, I'm very sorry for that because of exams. I think I can't just disrupt you and have a timetable which is always moving. So temporarily, I'm going to put your class on Thursday. I will also inform you in the group maybe by tomorrow. I will put you in a class on Thursday evening temporarily until the exams are done. Then we can see what can happen. Thank you so much. God bless you richly. Have a blessed evening.